Every successful private enterprise eventually hits a mathematical wall. To build international supply chains, fund advanced research, or dominate a new market, a company reaches a threshold where further growth requires hundreds of millions of dollars to survive. At this scale, traditional funding mechanisms break down. The founders have exhausted their personal capital. Bank loans of this size carry high interest rates and significant financial risk, while venture capital and private equity groups face internal limits on how much they can deploy into a single firm. This creates a strict capital deficit. The business has a proven model but lacks the raw financial fuel required to execute its global expansion. Bridging a gap of this magnitude requires the company to tap into the deepest, most liquid pool of money on the planet, the public markets. To secure that capital, the private company must completely abandon the closed corporate structure it was built on. The legal and financial gateway to this public liquidity is the initial public offering, or IPO. A public listing is frequently misunderstood as a purely ceremonial event, a morning of ringing bells where founders cash out their chips and walk away. Technically, an IPO is the very first time a privately held entity legally offers its equity to the general public. We are going to track the exact mechanical flow required to execute this transition, how a company mints new equity, routes hundreds of millions in fresh capital, and recalibrates its ownership structure. The IPO functions as an aggressive financial restructuring of the firm's DNA, arming the business for survival at a global scale. Corporate ownership follows a strict rule. A company's total value is perfectly divisible into discrete units called shares. This capitalization table for ABC Technology, valued at $2 billion, is divided into exactly 100 million shares. Saturners holds 60 million shares, equating to 60%. Venture capital holds the remaining 40 million, a 40% stake. Total ownership is locked at 100%. In this pre-IPO state, the equity pool is an entirely closed system. No outside public investor can buy in, and no new money can enter the structure. ABC Technology now faces a hard objective. To fund their new global expansion, management requires exactly $500 million in fresh capital. To secure this exact sum without taking on crippling debt, this closed 100 million share system must be forcibly expanded. The technical solution to this capital deficit is a mechanism called a primary share issuance. The company executes this by artificially expanding its equity pool, minting 25 million brand new shares that did not previously exist. The total outstanding counter ticks up from 100 million to 125 million. For this offering, the investment banks have priced these newly minted public shares at exactly $20 each. Multiplying 25 million new shares by the $20 price yields exactly $500 million. Tracing this flow resolves a major misunderstanding. The $500 million routes directly into the corporate balance sheet, landing squarely in the firm's cash ledger. This massive influx of cash does not go into the founder's pocket. It belongs exclusively to the corporate entity. A primary issuance is the exact mechanism by which a company trades newly minted equity in exchange for immediate operational firepower. We can contrast this primary capital flow with an alternative scenario, often seen during an IPO, the sale of secondary shares. Secondary shares are pre-existing units of equity sold by the incumbent owners, rather than new ones created by the company itself. If a founder sells 2 million personal shares at the $20 IPO price, the capital routing is different. This side-by-side comparison shows primary capital flowing into the corporate building, while the $40 million from the secondary sale routes directly into a personal bank account. Primary issuance builds the company's war chest. Secondary sales strictly provide personal liquidity for early investors, offering zero financial benefit to the corporate balance sheet. Returning to the corporate perspective, we have to examine the cost of this primary issuance on the incumbent owners. Mathematically, the founder still holds their original 60 million shares. They haven't lost a single physical unit of equity. What they have experienced is ownership dilution. This equation shows exactly how that works. Because the total outstanding share pool expanded to 125 million, the denominator changed. Dividing the founder's constant 60 million shares by the new 125 million share total shrinks their proportional power from 60% down to 48%. Dilution is the required tax incumbents pay to scale. They trade a dominant piece of a smaller, constrained pie for a minority piece of a massively funded, aggressively expanding global enterprise. This leaves one final variable in the IPO equation. How did the underwriters know the market would tolerate a price of exactly $20 per share? IPO pricing is never arbitrary. It is the output of a highly structured valuation process managed by investment banks serving as underwriters. These banks establish a baseline value using technical frameworks like discounted cash flow models, industry precedent transactions, and revenue multiples. To test those theoretical models against reality, the banks execute a phase known as book building. This ledger visualization represents the book building process. The investment banks query massive institutional investors, like pension funds and mutual funds, aggregating their exact volume demand and price tolerance against the finite supply of 25 million new shares to locate a clearing price. Book building acts as the vital bridge between theoretical financial models and market reality, locking in the final price before the public ever gets a chance to trade. Once the price is locked and the bell rings, the mathematical theory ends, and the chaotic reality of the public markets begins. The firm is immediately subjected to heavy regulatory burdens. This includes exhaustive quarterly financial reporting, continuous disclosure of material information, and strict independent audits. Beyond the paperwork, there is immense operational pressure. Management is now evaluated on short-term quarterly performance, altering how the business makes strategic decisions. The hundreds of millions of dollars raised in an IPO are effectively paid for twice, once through the mathematics of equity dilution, and again through intense public scrutiny and the permanent loss of private autonomy. ABC Technology has reached its new steady state. It is a public entity, heavily scrutinized, but armed with a $500 million balance sheet ready for deployment. The IPO marks the beginning, rather than the conclusion, of a company's financial engineering journey. It introduces the capability for follow-on offerings. The public listing acts as a permanent gateway. It allows the firm to repeatedly tap public liquidity through rights issues or convertible debt whenever future capital needs arise. This transition integrates a closed, capital-constrained private enterprise into the permanent infrastructure of the global capital markets.